and how the markets are reacting once again to U.S.-China trade headlines. Diana Avigdor is joining us. She's a portfolio manager and head of trading at Barometer Capital Management. Diana, I don't want to always talk about U.S.-China trade headlines, but my goodness, they really do impact the market. What's your view, and what did you see on the back of President Trump's comments this morning?
You know what? You're absolutely right. And I think that the China-U.S. trade talks are really not going to come to a head pretty much soon. And markets are, as you can see in the last couple of days, are better at not reacting to any of the headlines. I think the trade talks go on for much longer than we expect, and much longer than the December period. And it's not just about the September tariffs or anything like that. So there's a lot more going on here than just trade talks. I think there is some economic underpinnings that we need to talk about to explain why the market's acting the way it is, and it's as resilient as it is.
So let's talk a little bit about that. I just ran through a few of the economic headlines globally today, which I think are really important, but what specifically are you referring to?
Yeah, so we talked about, you and I, last time we were on air, about how the sentiment indicators were were weaker than the actual indicators. So we're looking at ISM, and ISM non-manufacturing was below 50, which points to a contraction. But manufacturing was weak, and sentiment was weak as well. So we're looking at we're pointing how sentiment was weaker because of the headlines, but the underlying economy was doing well. Retail came in a little better. Employment numbers are okay. I know that Canada was a little weaker today, and I'll just jump in on Canada. Rates, for example, in Canada have not been cut at all. So, Canadian central bank can be considered as one of the most hawkish globally, but we do have a pretty decent economy and a strong housing market. So that makes some sense, and maybe it was a bit of a pause on the employment side. So maybe there is some room for rate cutting. So the underpinnings of the global economy, if only in the North American side, we're expecting it to reaccelerate, and oil, for example, is reflecting that trade, and the rotation into the cyclicals for momentum is expressing that trade, and the rates globally, the way they have rallied back up, are expressing that trade as well.
But is that going to be correct?
Well, okay. So in the world, you do have to be right. There is always a possibility that's not going to happen. But if markets are a leading indicator, and if all these things are pointing to the same direction, it's possible that we're not going into a recession close around the corner. Now, earnings have been kind of flat and not so great, but not nearly as negative as was expected. It is clear, or almost clear, that the world is undergoing some kind of change that will be more permanent than just a trade agreement. And I think that the various pieces in the puzzle are taking their time in adjusting to it. But central banks are behind supporting this recovery. Earnings are okay. Some companies are doing really well. Our internal indicator work is pointing to positive. Bond markets, bond yields, like France, for example, was negative. The 10-year was negative until yesterday. And today is the first time in 11 months that no portion of the U.S. yield curve is negative. That we had $17 trillion in global bonds in negative territory.
Diana, do you mean Europe?
U.S. The U.S. yield curve is not inverted in any parts of its curve.
Okay.
France has gone positive yesterday from a negative yield. Germany went from -70 to -25. So it's getting better.
So what's the theme then for you and your team that you want to execute on? Let's say, I mean, again, because there is just so much volatility and trade headlines that really change the thematic investing every day. I was talking to somebody this morning, and the reality is as well, like the hedge funds that have their way that they go about investing, they're all underperforming the broader market. So it's very difficult to buy into a theme and to kind of stick with it. I mean, people stick with it, but to have it really work for you. Is there a theme that you believe we can buy today and hold for, I don't know, a half a year, 1 year? What are you thinking?
You're absolutely right, Catherine. Everybody is underperforming the broader market. Why? Because the beginning of the year, because Q4 18 was so weak, it took a little bit of time on January until everybody got in, so you missed that portion of the rally. Then back in April, you started some rotation from what worked to what actually totally didn't work. And we've gone from value to cyclical in the last month. So unless you got it perfectly right and moved your portfolio 100% around, there was no way that you could have participated in the same way. Now, your question is, where can you be for a long, long time?
Yeah.
You must ignore the short-term gyrations. So, if you're wrong for a period of 3 to 6 months in this 1 or 2 year period, the assumption is that you're not going to switch around. The problem is that people do switch around. I think that we're invested for a reflation trade. Long-term, say over 1 or 2 years, we tend not to predict because we're very acceptant of the market telling us what to do. So if things change, we'll come out and say we're changing. But now the way it's looking like a reflation trade. It's looking like the market's good for a year or two. We like the fourth quarter, and now I'm going to throw in one short-term item. Mm-hmm. The quantitative strategies that you were talking about, the hedge funds, the risk parity, those are short-term moving money, and they impact the market and pricing a lot. And we've been talking about this. The rally into where we are today had to do a lot with short covering, because what were they long? They were long momentum and short value, short cyclicals. So they're long what's working, short what's not working. When that shifted, it forced a short covering event.
Right.
There's been lots of short covering going in these cyclicals. Now, what happens when you're a hedge fund and you have to keep a balance of short and long? When you cover your shorts, all of a sudden your exposure as a number becomes larger. So what do you need to do? You're now levered because you took off your shorts. You must sell some of your longs. So this is why I'm anticipating that over the short term, the next several days, couple of weeks, that we might just grind in place here, maybe a little bit of softness as this rebalances.
Okay.
But because of all the Fed, the economics, the breadth indicators, we think that Q4 will be quite good. Exposures are not the way they were in Q4 18. People are a lot less invested, and therefore any sell-off will be shallower.
Okay, Diana, we got to leave it there. Great to see you. Thank you.
Thanks, Catherine. Bye-bye.
Thanks. That's Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management.